Good evening. My name is Steve Kirsch. I'm the Vice Chair of the Pension Committee. I'll be running the meeting at least from the beginning tonight. This is the regular meeting of the Town of Monroe Pension Committee and OPEB Board of Trustees joint meeting for Thursday, October 24th, 2024. The time is now 6:05 p.m. First item is roll call. I'll call pension first. Terry Rooney. Here. Joe Cobsa. He said he emailed that he would be absent. Frank Duchess. Here. Steve Kirsch, myself, I'm present. Rebecca O'Donnell.
Here.
Jonathan Formicella. Here. Jason Mauer. Jason's not present. Chrissy Martinez.
Here.
Dennis Condon.
Here.
Thank you. For the OPEB board, the chair, Mike Vitello, has indicated he will be absent tonight. Rebecca O'Donnell.
Here.
Jonathan Formicella.
Here.
Terry Rooney.
Here.
Ron Bonofsky.
Here.
And it should be noted that Heidi Mead, Deputy Finance Director, is here, as is Devin Francis, our advisor. The first item of business tonight is the review of the minutes. I will like to have a motion for the approval of the Pension Committee minutes and voting record for July 25th, 2024.
So moved.
Do I have a second?
Second.
Thank you. Does anybody have any updates or changes? Hearing none, I guess I have to do a roll call, right? Roll call will be Terry Rooney.
Aye.
Frank Duchess.
Aye.
Rebecca O'Donnell.
Aye.
Jonathan Formicella.
Aye.
Chrissy Martinez.
Aye.
And Steve Kirsch, aye. Dennis Condon. I'm sorry, Dennis. Thank you. I will now entertain a motion for approval of the OPEB Board of Trustees minutes and voting record for July 25, 2024.
So moved.
Do I have a second?
Second.
Second, Mr. Rooney. Rebecca O'Donnell.
No discussion.
No discussion, I'm sorry. Any discussion? No discussion. Hearing none, Rebecca O'Donnell.
Aye.
Jonathan Formicella.
Aye.
Terry Rooney.
Aye.
Ron Bonofsky.
Aye.
Thank you very much. The next item is new business. We have two leadership votes tonight. I'm going to do the OPEB Board of Trustees Vice Chair. Before I go on, for the record, since our last meeting, Rebecca O'Donnell has been elected as Chair of the Board of Finance, and as such, she will be a representative from the Board of Finance to the Pension Committee, and by town regulations, she will be a member of the OPEB Board of Trustees. Going on to new business, we have two leadership votes. I communicated with Mike Vitello, and I will lead the vote for the Vice Chair of OPEB Board of Trustees, and so I will open the nominations for anyone for Vice Chair.
I move to nominate Rebecca O'Donnell to be Vice Chair of OPEB.
Is there a second? Second, Dennis Condon. What? Dennis is not. Yes, you've got to be a member of OPEB. Thank you. Ron will second it. Thank you very much.
Hey, everybody. Jason Mauer just logging in.
Oh, okay.
Thank you, Jason.
Until 8 p.m.
At 6:08. Thank you. Okay, I have a nomination and a second. Is there any discussion?
No.
Hearing no discussion, I will call the roll. Rebecca O'Donnell.
Aye.
Jonathan Formicella.
Aye.
Terry Rooney.
Aye.
Ron Bonofsky. And passes unanimously. We now have an opening for the chair of the Pension Committee, and I will entertain nominations for the chair of the Pension Committee.
I move to nominate Rebecca O'Donnell to be Chair of the Pension Committee.
I move to nominate Steve Kirsch as Chair of the Pension Committee.
Second, Rebecca's.
Rebecca has a first and a second. There's a first for Steve Kirsch. Is there a second?
Second for Steve Kirsch.
Thank you very much. Okay, so I guess we will simply do this in order. Those, for Rebecca, I will call the roll. Terry Rooney.
Aye.
Frank Duchess.
Aye.
Rebecca O'Donnell.
Aye.
Jonathan Formicella.
Aye.
Jason Mauer. Chrissy Martinez.
Nay.
Dennis Condon.
Aye.
For Steve Kirsch. Those who have him, Chrissy Martinez.
Aye.
Jason Mauer.
Aye.
And myself, and I. Rebecca has it. Congratulations, you are now the chair. And the meeting is now yours.
Great, thank you. So the next on new business, the pension and OPEB quarterly investment review, the third quarter for 2024. So we will open it up.
Thank you. Congratulations on your appointment. Just want to get a quick pulse of how much time would folks like me to take. Terry, I know you said you need to duck out shortly, but I don't know if there are any time constraints.
Just go through it, please.
Regular, okay, great. So the fiduciary governance calendar is on page 5. This quarter it is municipal landscape update, which I know generally this group likes because it's kind of peer benchmarking. So it's pretty interesting. So on page 6, you'll see the most recent data points for the pension and the OPEB plans. Now, USI, basically Hooker and Holcomb, does the valuation every other year. So they are, I assume, in the midst of conducting the 2024 Val report. So these data points are a little bit stale. They're as of July 1st, 2020. But you can see that for the town pension and the Board of Ed plan, you have a stellar funded status, almost 99% funded for the town pension plan, and then 97.4% for the Board of Ed plan. For the pension plans, you are using an actuarial return assumption of 6.75. I know that there has been discussion in the past, and I believe it's earmarked for follow-up, where there has been a consideration of lowering that return assumption. And that's actually something that we'll touch upon in the following slides.
Devin, question. In the Board of Ed,
Yes.
they both read 7/1/2022.
Oh, I'm so sorry. The one on the far right-hand column is 2020. Thank you for catching that, Frank. So the OPEB plan is, OPEB plans generally are not as well funded because they're generally in the ramp up process, but you'll see that compared to most municipal OPEB plans, your plan is also very well funded in relative terms. So the funded status did jump from 2020 to 2022 because of contributions that were made. So you have a funded ratio of 82.7, and the actuarial return assumption that's being used for the OPEB is 6.5%. So just slightly below using pension plans. So if you move ahead to page 7, here's where you can get a sense of what other towns and cities are doing in terms of their return assumptions. So I mentioned that there's been some conversation about lowering the town's return assumption, which currently is at 6.75 for the pension. You can see here in the top bullet that the average return assumption for municipal pension plans across the state of Connecticut was 6.43 in the most recent fiscal year, and the median was 6.5%. So both the average and the median are modestly below where the town of Monroe is. And what you can see on the bottom right-hand graph is that you can see that both the average and the median return assumption has trended down quite significantly over the past 8 years or so. It's our expectation that well, first of all, we have certainly seen a slowing in the decline of interest rate assumptions, and it's our expectation that we'll kind of see things level off for two reasons. First is that return assumptions have come down so that by and large, they are in a reasonable and justifiable range. And then the other part of that is that now bond yields are higher than they have been. And so investors that have a portion of their portfolio allocated to fixed income, which is nearly everyone, is now getting more from their bond portfolio. And so that piece of the portfolio is generating stronger returns. Therefore, there's not as much of a need to significantly reduce that return assumption. But it can be kind of interesting if you look at the graph on the bottom left-hand side, which shows the bar charts, the blue and the green bar charts. You can see that, certainly there has been, when we compare 2022 to 2023, now more folks are in the, 6.5 to 6 3/4 range than 6 3/4 to 7. We've seen just by and large a trend towards reducing that investment return assumption. So obviously the folks at USI actually is the one that does this benchmarking report. So I believe that it was teed up as a potential discussion for the January meeting where Stefan was going to come in and give some, data points that could help folks make the decision. Given the fact that your funded status is so healthy, it's probably a good, and actually when you get the most recent valuation report, it should be even better because asset returns have been very strong. So certainly the portfolio's assets have grown, so it's quite likely that you're actually at more than 100% funded. So certainly there would perhaps be the ability to lower that return assumption. The other side of the coin is that when you lower the return assumption, that means that the ADEC or the ARC, it used to be called the ARC, is generally higher. So because you're expecting the assets to grow at a more modest pace going forward, the amount that you're required to contribute to keep up the funded status is generally increased.
So just so you understand, that increases the budget for that.
Yeah.
Great. So on page 8, you'll see they kind of break it down into plan size and what impact that has on investment return assumptions. So by and large, the largest pension plans have a higher return assumption, and the smallest pension plans tend to be a little more modest in terms of their return expectations. And so if you were to compare the town of Monroe, you fall within that 10 to 49 million range. So for that group, the average investment return assumption is 6.6% in fiscal year 23. Again, you're a little bit higher than that at 6.75. And then on page 9, we can see trends in funded ratios. You can see because of really strong market results, there was a spike up in 2021 and then the subsequent decline in 2022. So the average median funded ratio was at 77.6, I think, in 2023. The good news is that even though we only have 2022 results for the town of Monroe, as I mentioned, your funded status is incredibly healthy, 98.7% for the town pension and then 97.4% for the OPEB. So if you think about this graph and, in 2022, the line was right at about 75% funded or so, your data point would have been almost at the very top of the graph, so approaching 100%. So certainly you are better funded than most towns and cities across the state of Connecticut. And then again, we see the trends in funded status according to plan size. So in 2023, for plans that fall within your peer group of 10 to 49 million, the average funded status was 76.7%. So again, you are in a very good position in terms of your funded status compared to peers. in terms of your actuarial return assumption, the return expectation that you are factoring in, or that the folks at USI are factoring in, is a little bit more aggressive than what we're seeing on average. And then page 11 shows some of the trends within the OPEB space. So again, I mentioned that OPEB plans are generally less well-funded than pension plans. So you can see that on average, the OPEB plans were at 41% funded, and you are at 82.7% funded. Again, in terms of the actuarial return assumption, you're a little bit higher at 6.5%, whereas the average, or I'm sorry, the median for OPEB is at 6.25. Any questions about any of these peer benchmarking data points? And then I guess I have a question for this group. Would you like me to coordinate Stefan doing that work and perhaps coming to the January meeting, or would you rather be in touch with him, Ron, and ask him to, I mean, I know that anything he does is going to come with a bill, so.
Yes, so I guess I can coordinate,
If there's even an appetite for that.
yeah, so I guess my thought is maybe hold off on asking him to come, but I think the conversation of, because, raising or decreasing the return assumption is going to decrease our funded status, right? So, which I think based on where our peers are, probably makes sense, and where the markets are looking forward, it probably does make sense to pull it back to the 6.5 range.
What's the benefit to pulling it back?
It's a matter of, do you want to be in a realistic range, So.
Well, again, we're going to get to what our return is.
Exactly.
And
But it's not only the current return, it's looking
right,
forward.
right.
Yeah.
No, I understand. But is there, besides getting to realism, is there another benefit to it?
I guess are you aware of any?
No, not really.
Okay.
It really, Frank, it's a lot about perception, and there is a headline risk to having an actuarial return assumption that's a little bit too aggressive. 6.75 versus 6.5%. I don't think that headline risk exists. I know, the city of Hartford, I think, had an 8% return assumption and it was like, that was all over the headlines. Like, how foolish can they be to expect that? So that it can be an element, but in this case, I don't really think that's.
I mean, we've carried this for a while, and we've said at each of these meetings that we'll look at it, out, because, at some point, I think we have to, bite the bullet and actually.
For a long time, we were ahead of the curve. I think we had pulled it back.
We were
quicker than-
lower,
Yeah.
and we became more aggressive, and
Yeah. So,
I mean, I personally want to be as quote unquote accurate as we can. I don't mind hanging out for a little while till you have good numbers and you're pretty sure where things are headed, but.
I mean, is there there's no type of deadline we could do this?
No.
Yeah,
No.
we can do it at
Why
any
not?
time.
We could do it in the next quarter, the quarter
Right,
thereafter.
we could see what the political landscape is or financial landscape is after, major presidential
Well,
election.
that's why we
In
said.
2 weeks.
Whether or not that wouldn't have an impact on our capital market assumptions. I know it's hard to believe, but.
So if I look at some of the previous charts, it basically says there's about 43% of the municipalities out there that carry a higher return assumption than we do.
Frank,
What page?
I went back to page 7, the bar chart. I mean, if you just add up the pieces, right?
Yep. That's accurate.
Yeah,
Yeah, so you're not out of the realm of,
right.
You're not unreasonable.
you're
Again,
near the top of the bell curve.
Yeah, I think from my perspective is the discussion's worthwhile. When we get to the part where we compare against our actual return, and I realize it is forward-looking, but what do we believe are going to be the assumptions going forward that would tell us we should reduce it? As opposed to just, we kind of think,
Right.
what are the assumptions that are going to take us there?
And That is actually in next quarter's governance calendar, where we'll share our updated capital market assumptions
Okay.
and we'll do asset allocation modeling. So we'll be looking at an exact
Yeah.
number.
So
My sense would be if we're going to do that, we wouldn't make a decision until we see that.
Right.
Right.
That's right. That's next quarter.
I think that makes sense.
Yeah.
So maybe we have USI come in maybe
The
the following
following,
quarter,
yeah.
if
April,
if it warrants that.
Okay.
Okay, all right, so if we move on to the capital markets review and you take a look at page 13, I mean, the biggest news for the quarter was, of course, the first Fed rate cut. The Fed cut by 50 basis points. The leading up to about probably 2 weeks before the meeting, general consensus was an expectation of a 25 basis point rate cut. And then there was a weaker than expected unemployment number that came out just before the Fed's meeting, and they ended up cutting by 50 basis points.
Well,
So-
it's interesting, the bond markets did not follow
I
the
know,
Fed rate cut.
isn't it? Yeah, it's very interesting.
Yeah.
Yeah. So, you know, if you look at the top right-hand side of page 13, this shows the historical cutting cycles, how long they have lasted, and by how much the Fed has cut rates. And what you can see is that there's just a ton of dispersion around these cycles. So some of them have been very long with very minimal rate cuts. Some have been incredibly short with, you know, massive rate cuts. Back in the, I think it was the 80s, the Fed
81.
cut by 900 basis points in their first cut. So there is a lot of variety in terms of the history of cutting cycles. On average, the average cutting cycle has lasted almost 2 years, so 22 months, and there have been 600 basis points of cuts. We started off at 525, so there aren't even 600 basis points of cuts that could be possible. So, you know, we expect that this cutting cycle will be more modest. Maybe, say, if we had to guess, maybe something in the realm of like 18 months long, and probably 150 basis points of cuts, somewhere in that neighborhood. On the bottom left-hand side, you can see how markets have typically reacted following the onset of a Fed cutting cycle. And on average, they've been positive. So if we're looking at large cap stocks via the S&P, or small cap stocks via the Russell 2000, or bonds via the Barclays Aggregate Bond Index, you see positive returns on average for each of those areas of the market. Now, if you look at each of the cutting cycles individually, you see, again, very wide dispersion in returns, which is really a reflection of how the economy was doing. So was the Fed cutting rates because we were in a recession and they were trying to kind of get the economy back on track? Or was the Fed cutting rates just to get back to kind of normal levels? So again, a lot of dispersion, but we don't think that we're in a recessionary environment right now. It does seem as if all signs have pointed or are pointing to the Fed navigating this soft landing that they've been trying for. So it's our expectation, if we had to, you know, build a forecast, that we probably should see pretty strong results across the investable universe. And then, Jonathan, the graph on the bottom right-hand side speaks exactly to the kind of the political landscape. And, you know, I know that politics can be very passionate, or people can be very passionate about politics. And, you know, we encourage people to vote with their vote and not with their portfolio. And so this just shows that over time, markets generally tend to move up. And there's an interesting study that I forget what exactly the dollar amounts were. I think it's like starting with $10,000 in 1960. If you had stayed invested only under Republican leadership, when there was a Republican president, you'd end up with, I think it was 500,000 at the end of this period of time. If you invested only under Democratic leadership, you'd end up with 1.3 million. But if you stayed invested the entire time, it was like 10 times that earning. So, you know, it's spending the time in the markets regardless of which political party is in office.
The trend is up no matter what.
Exactly. In terms of the broad economy on page 14, you can see some graphs. Generally speaking, it does seem, again, as if things are kind of chugging along. Inflation is coming down, which of course is not only the Fed's goal, but is also the goal of all of us who don't like these high and rapidly rising prices. So it's good to see that inflation number trending downward. We are seeing a bit of a rise in unemployment, but again, nothing is at concerning levels. It's not blinking red recession, warnings. So unemployment the labor market is still pretty much at full employment, and then GDP growth remains strong. We do expect that GDP growth is going to be slowing in the coming year, but will remain in positive territory. So things are generally doing pretty well within the economy. The dollar index, you can see, has been trending downward. That actually ends up being a tailwind for international stocks, so that will be helpful for a piece of your portfolio. One of the things that we are seeing, and this is something that I've mentioned in previous meetings, is that the consumer is showing a bit of weakness. We've had a bit of an increase in credit card defaults. Those savings balances have dwindled. So perhaps not quite as financially stable as they were a year or two ago, but still, fairly healthy overall. So on page 15, you can see the asset class returns so far this year. So these numbers are through 9/30. The bars represent the asset class returns for the year to date. And then the bubbles represent the third quarter asset class returns. So US large cap has been by far the market leader. You can see that section of the market has been up over 21% through September. But what's interesting is that, US small caps have substantially lagged compared to large caps. And we're still talking about a return north of 11%. So in absolute terms, we're still looking at really good results. But what's interesting is if you compare the difference between the third quarter returns. So small caps beat large caps by more than 3 percentage points in the third quarter. This is something that we've been saying, that small caps will be the bigger beneficiaries of a cutting cycle. Smaller companies are more heavily reliant on debt. As the cost of servicing that debt comes down, that's a tailwind for small cap companies. So we saw them kind of bounce back in the third quarter. And it's our expectation that we could see continued strength in small caps. One of the things that's been kind of a hindrance to your portfolio has been the small and mid cap exposure. In the third quarter, we actually saw those two active SMID managers outperform the S&P 500. And then great results from international developed and emerging markets, strong results from REITs and real assets. REITs are very highly sensitive to interest rates. So when interest rates declined in the third quarter, you saw REITs have a really strong quarter. And then fixed income has been pretty strong. So all the way on the left-hand side, you can see various fixed income indices. Again, the third quarter is when we had that first rate cut, and the aggregate index was actually up 5.2% in the quarter. So pretty good results for a diversified portfolio. Everything is in positive territory, and it's, just to what degree. And then finally, the last thing, that if we could just forward ahead to pages 21 and 22. I know I harp on 21 all the time, the importance of diversification. There's always going to be something in the portfolio that is not doing as well as something else. But then chances are when, the market environment shifts, then that asset class will kind of save the day. So there's very little rhyme or reason as to what tends to be the best performing asset class on a calendar year basis. But what you can see is that the balanced portfolio, shown in orange, never the best performer, but it's never the worst performer. So you end up reducing that volatility and creating a steadier return stream with less downside risk by having plenty of diversification in the portfolio. And then the very last thing is that on page 22, if you draw your attention to the 1 year column and the equity markets section in the middle of the page, just look at how remarkable the last 12 months has been in the markets. S&P up 36.4%. The Russell 1000 growth, which is large cap growth names, those big tech names that you hear so much about, up more than 42% over the last year. And even the weakest area is the international developed markets, the value index, still up over 23%. And that's the weakest area of the global equity markets over the past year. So some really, really strong results. And, to your point, Frank, looking at the pension and the OPEB portfolios and how they've actually performed, they've, hit it out of the park and way outperformed that 6.75 return assumption. It's not the type of market environment that we expect going forward, but certainly it does kind of help build up the coffers.
We're in the third year of a boom market.
I know, yeah, it does leave you scratching your head a little bit, not really justifiable. Although I will say that at least we're seeing price increases within the S&P, but we're also seeing earnings growth. So it's not like it's only price expansion. So that does give you a little more comfort. But yeah, things look pretty expensive out there. Any questions about the markets? So if you move ahead to the third section, page 24, this is the town dashboard. So you can see on the top right-hand side of the page, that's where we show the dollar amount. So the town plan ended the quarter at 16.1 million. And if you look on the top left-hand side, that's where you can see the return stream. So again, really strong results so far this year. For the fiscal year to date, we have one quarter. So the portfolio is up 6.2% in that quarter. On a calendar year-to-date basis, the portfolio is up 14.1%. And then for the last 12-month period, the portfolio is up 25.2%. So really strong results, again, well ahead of that actuarial return assumption. The 3-year number is much more muted because you have 2022 in there. And remember, 2022 was sharply negative, not only for stocks, but also for bonds. But then the 5-year, 7-year since inception results all either above or in line with that 6.75% return assumption. So things are looking pretty good. And on the bottom right-hand side, we show the asset allocation profile, and then that's also shown a little more closely on page 25. You are mostly aligned with the target allocation. You'll see that there is a little bit of an underweight to fixed income, and that's largely just a result of market movement. So equity markets have been stronger than the fixed income markets, so the fixed income portion has become a little bit more underweight. What we tend to do is when we raise cash on a quarterly basis, we will take from the areas of the portfolio that are overweight. So we'll be trimming equities and, kind of getting back in line with the targets. But certainly we are well within the allowable parameters that are established in the IPS. So you can see those parameters on the bottom right-hand side of page 25. So for instance, minimum of 15% to fixed income, maximum of 45%. Even though we have a little bit of an underweight compared to our 30% target, you're still well within those confines. And then page 26 shows all of the underlying strategies. Again, everything is a mutual fund. So all of these funds offer daily liquidity. All of these managers are on maintain status, which means that our research group has, continued to perform due diligence and has no concerns, no red flags. We don't have any recommendations for any changes. We think the portfolio is in great shape. So for that 30% target to fixed income, you can see there's a lot of diversification within the fixed income managers. The two most traditional fixed income managers are the Harbor Core Bond Fund, that's sub-advised by Income Research and Management, and then Baird Aggregate Bond. So those are going to be the most, typical investment grade credit or government bonds, a duration similar to that of the aggregate index. And then we have the diversifying strategy. So we have a little bit in TIPS, which are linked to inflation. We've got 5.5% in the BlackRock Strategic Income Opportunities, which is a kind of a go anywhere fixed income strategy. It tends to be a little more defensive. And then you have global bonds through Dodge and Cox. So a lot of diversification across the fixed income spectrum. Then on the domestic equity side, the largest portion of that piece of the portfolio is in the Vanguard 500 Index Fund. So you get that S&P exposure at a very low cost. And then we have those active managers on the mid cap side. So Diamond Hill has a value approach and Conestoga has a growth approach. So they're neutral from a style perspective. And then on the international equity side, we have all active managers. When we look at the longer term results of that piece of the portfolio, you see a lot of outperformance. So these managers have performed well for you. So Dodge and Cox is the developed markets value manager. The John Hancock Fund is sub-advised by Axiom. That's the developed markets growth manager. And then you have a similar pairing on the emerging market side. ARGA is the value strategy. GQG is the growth strategy. And then the last piece of the portfolio is the Principal Diversified Real Asset Fund. That's the fund that has exposure to REITs, infrastructure, TIPS, commodities, natural resource equities. So again, thinking back to that quote chart where that shows the importance of diversification, you can look at this portfolio and see there's a lot of diversification. And let's see. Pages 29 through 31 show all of the underlying asset class composite returns and then the individual manager returns. I won't bore you to tears by going through every section, but the fixed income managers have added value. On a one-year basis, they're about 80 basis points ahead of the benchmark. The domestic equity managers on a one-year basis have lagged. I'm looking at page 30 now. But when we think about absolute returns, that portion of the portfolio is up 32.8% over the past year. So great absolute returns, a little bit of relative underperformance just because of the small and mid-cap exposure. But again, those small and mid-cap funds both outperformed the S&P in the third quarter when we saw, that the rate cutting cycle begin. And then the international equity, you look at the year to date and the 1 year results way ahead of the benchmark. You've got those active managers that are providing value. And then the principal fund has been a little bit more defensively positioned. So they have underperformed their benchmark. But in terms of the absolute results, you're looking at almost 17% over the past year. And we also, the reason that we have that in the portfolio is for diversification purposes. So that's not going to behave exactly like everything else behaves. So it helps improve the correlation metrics. So that's the town pension. The Board of Ed pension is positioned exactly the same way. If you move to section 4 and just look at page 39, just to get a sense for the dollars, the Board of Ed was slightly higher than the town at about 16.9 million at the end of the quarter. So pretty similar allocation metrics, but just a little bit bigger. And then you have the same general returns shown on the top left-hand side. And then if we move ahead to the OPEB portfolio in the final section of the report, and you look at page 53, you can see that the OPEB ended the third quarter at 2.9 million. So remember, we looked at the funded status, and the funded status had improved significantly from 2020 to 2022 because of contributions. You since have contributed even more, so that that market value is much higher than it was, a couple of years ago. This portfolio has much less active management. So the only area of the OPEB portfolio where we're using active managers is in fixed income. And that was a fairly recent change. Everything else is passive. And so you see that the results on the top left-hand side are very closely aligned with the benchmark because there is not much active management. So again, on a calendar, for the quarter, portfolio was up just about 7%. On a year-to-date basis, almost 13%. And then on a one-year basis, up more than 24%. And then going back to its inception in 2018, you're looking at a 7.5% annualized return. And this portfolio, you can see all the underlying managers on page 55. So again, we're using two of the same bond managers that we use in the pension. We have Baird, which is the traditional bond strategy, and then BlackRock, which is the more flexible fixed income strategy. And then everything else is just passive through the bank. Any questions about anything I have covered?
So I do, and this is just because I haven't been involved, but the strategy to go from active to passive, OPEB, when did that take place?
That happened at the very end of 2023.
2023, okay.
So the way that I can find that, not that I ever expect you to go and find it for yourself, but that when you look at the what starts on page 58, so this is the underlying manager return streams, there is an inception date column of the right-hand side. So you can see that December of 23 was the first full month that those funds were in the portfolio.
Okay, thank you.
Welcome. So again, just to reiterate, we think everything's in great shape. We don't have any recommendations for any allocation changes. We will be doing the asset allocation modeling based on our updated capital market assumptions. So next quarter, you may remember this at the beginning of this year, we increased the exposure to fixed income based on those capital market assumptions because our outlook had changed significantly. I don't expect that we'll see a significant change this year. But we may have some modest allocation suggestions. Again, the managers for right now are in good shape, but it's always possible you could see a portfolio manager departure or, unexpected performance. So we'll continue to keep our eye on all of the underlying strategies. But for now, I think we're in good shape.
Thank you, Debbie.
Thank you. The time is 6:46. Do I have a motion to adjourn?
Motion to adjourn.
Second.
Thank you.